Okay, the dangers of over leveraging, and this is very important, and in my opinion, one of the biggest problems with the Forex market today. Okay, it's an extremely big problem for retail Forex traders, in my opinion. One of the reasons is because the lack of regulation in the Forex market, being a global market. Now, we do see individual countries taking steps to decrease the amounts of leverage that are allowed, the U.S. being one of those countries. But you still see countries out there that allow 500 to 1 leverage, which is just absolutely ridiculous and very dangerous to retail Forex traders. And it's really playing on that instant gratification and that get-rich-fast mentality. Okay, so a lot of new traders get sucked in by broker ads for the ridiculously high amounts of leverage available. These brokers are preying on smaller retail investors that do not have the amounts of capital required to trade standard lot sizes safely. Instead, they allow you to borrow their money to trade large lot sizes on margin according to the amount of capital you have put up for collateral. New traders see dollar signs and the chance to make big money with their smaller capital. However, it rarely works out that way. All right, now some of the obvious reasons leverage can be dangerous are risking too much for your account size, large levels of drawdown, catastrophic losses, and dropping below your mental capital. Even if you're using stops to manage the risk while using higher leverage, there is no guarantee that your stop will be honored at the stop level during highly volatile price moves. Any slippage using high leverage can seriously damage your account. I can think of one instance recently here, and I mean there's plenty more that could be, just from data releases that turn very volatile, or interest rate statements, things like that. But when the S&B came out with the surprise move with their monetary policy, where they decided they were not going to defend that floor, the 120 floor, against the euro, we saw absolutely huge moves on the Swiss franc that the electronic systems were not able to keep up with. Stop losses were useless. The slippage was ridiculous. We saw hedge funds go under. We saw entire brokerages go under. Okay, so I want you to think about things like that. Every time you have a 10 pip stop and you're using 200, 300, 500 to 1 leverage. Okay, how much would that hurt your account just by going 10 pips below your stop, 20 pips below your stop before the stop is actually triggered? Okay, these are things that you have to consider. One of those disclaimers that you're going to read on any site, on any Forex broker site or anything, has to do with electronic trading and the dangers of electronic trading, and a disclaimer from electronic trading, having to deal with the hardware, the internet connections, and all that kind of good stuff. Okay? These things can fail, and they are not responsible for it. All right, the Forex market's a very volatile market. Very volatile market. And it's not very realistic to try to use super small stops in this market where you would use that type of a leverage on a daily basis anyway. All right, and just because it's available doesn't mean you have to use it. Adjust your trade size, trade smaller, give your trade some room to breathe. Just because you can trade standard lots with your $1,000 account with small stops, because you have that amount of leverage available, doesn't mean that you should be doing that. Okay, you definitely should not be trading standard lots at that account size. Okay, so if you're serious about staying in this business over the long term, do not use large amounts of leverage. It's pretty much as simple as that.